Guys, if you've seen the headlines today, you've probably noticed a celebratory tone around retirement accounts. The number of 401k millionaires has surged again as the stock market rebounded over the past couple of years. Now, on the surface, that sounds like incredible news. More people crossing the seven-figure mark inside of their retirement plans suggests financial progress. It creates the impression that long-term investing is working exactly as promised. And in many cases, it is. But underneath that positive headline is a much more complicated story about who is actually prepared for retirement and who is not. Now guys, I'm going to break down all of the details for you in this video, but in case you're new around here, my name is Nima and welcome to the channel. I'm a corporate executive with over 15 years of experience in both sales and finance. My videos break down complex financial concepts to help you on your financial journey, whether you're just starting out or if you're already a seasoned pro. So guys, let's jump into today's topic, which is the 401k millionaire boom and why most people still aren't ready. That account jumps to $960,000. So let's go ahead and start with what's driving the boom in the first place. When markets recover sharply after downturns, retirement account balances can rise fast. If someone had $800,000 invested in the market and it climbed to, let's say, 20% without a single extra dollar contributed, then you add continued contributions and employer matches, and then you're crossing the $1 million mark very realistically. Now, compound growth does a lot of heavy lifting in strong market years. That's what we've seen recently after prior volatility. Rising asset prices inflate balances quickly for those that have already heavily invested. But, guys, here's the key distinction. Averages and headlines often focus on the top slice of savers. The number of 401k millionaires growing does not mean the typical worker has $1 million saved. In fact, median retirement savings remain far lower than most people assume. The median is the midpoint, meaning half of the people have less than that number. This gives us a much clearer picture of the typical household's preparedness. And that picture is far less comforting than the millionaire headline suggests. For example, while top-tier savers may have seven-figure balances, the median 401k balance for many age groups is often in the low six figures or even below that. For workers that are in their 40s or 50s, median balances frequently fall well short of what financial planners recommend. That gap matters because retirement math is quite unforgiving. So, if you retire with $150,000 saved, that produces a very different lifestyle than retiring with $1.5 million saved. That wealth gap inside retirement accounts mirrors the broader wealth gap in society. Market gains disproportionately benefit those who already own more assets. So, let's just go ahead and break down this simple math. Suppose someone has $1 million in a 401k. A common guideline is the 4% withdrawal rule. 4% of $1 million is $40,000 per year. That means that, in theory, the portfolio could support roughly $40,000 annually before taxes, adjusted over time. Now, compare that to someone with $200,000 saved. 4% of $200,000 is only $8,000 per year. Guys, that's a pretty dramatic difference if you ask me. Now, in another example, let's look at how someone even reaches $1 million in the first place. Imagine investing $10,000 per year with an average annual return of 7%. After 10 years, you would have roughly $138,000. And then after 20 years, you would have about $410,000. And then after 30 years, roughly $944,000. The final decade contributes disproportionately because of compounding effects. That's why consistency over long periods matters so much. But guys, not everyone can afford to invest $10,000 per year. That's where income inequality shows up clearly. Higher earners can max out their 401k contributions, which in recent years allows over $20,000 annually, plus employer matches. Lower income workers may struggle to contribute even a few $1,000s per year. Over decades, that difference compounds dramatically. The system rewards those with higher starting capacity. But with all of that being said, before I dive into more details of the 401k boom, guys, if you are gaining value from this video, I'd really appreciate it if you could smash that like button, leave a comment down below, and subscribe. Your support helps this channel grow, so please guys, show some love by smashing that like button, commenting down below, and subscribing. Alright, now let's discuss the next segment. So, there's also the role of the employer matches. If your employer matches 5% of your salary and you earn $100,000, that's $5,000 of free money annually. Over 30 years at 7% growth, that alone could grow to hundreds of thousands of dollars. But if you work in a job without a retirement plan or without a match, you unfortunately lose that advantage. Access to workplace retirement benefits is uneven across industries. That unfortunately creates another layer of disparity. Another thing to think of too is market participation and how that also matters. Some workers panic and pull money out during downturns. Missing just a handful of these markets' best recovery days can significantly reduce long-term returns. Meanwhile, disciplined investors who stay invested benefit from those rebounds. The recent surge in 401k millionaires reflects not just market growth, but also the behavior of those who remained invested. Behavior also plays a huge role in these outcomes. Now, guys, let's talk about what not ready actually means. Financial planners often suggest replacing 70 to 80% of your pre-retirement income. So, if someone earns $80,000 per year, they might aim for $56,000 to $64,000 annually in retirement. Social Security may cover part of that, but personal savings must find a way to fill that gap. So, if Social Security provides $25,000 annually, the remaining need might be $35,000 or more. That requires substantial invested assets. Using basic math, if you need $35,000 a year from investments, and then you apply the 4% rule that I was mentioning earlier, you divide that $35,000 by 0.04%. That equals $875,000. That's the approximate portfolio size that is needed to generate that sort of income. And guys, if you didn't know this already, many households are far below that level. That's why the growth of 401k millionaires doesn't mean that the retirement crisis is solved. It just means that the top tier benefited strongly from the market performance. Now, another issue is the rising costs in retirement. Healthcare expenses continue to climb, housing costs, property taxes, and insurance have increased in many regions. Longevity risk is also real as people are living longer than previous generations. A retirement that lasts 25 to 30 years requires very careful planning. Underestimating expenses can quickly erode your savings as well. So, what does that mean? Well, the wealth gap becomes clearer when you compare percentiles. The top 10% of retirement savers often hold a disproportionately large share of the total retirement assets. Meanwhile, the bottom half may hold very little in tax-advantaged accounts. That imbalance means that market booms widen the gap even further. When stocks rise 20%, someone with $2 million gains has $400,000 on paper. Someone with $50,000 gains has $10,000 on paper. Both benefit, but not equally. So guys, I ask you, what can individuals take from this? Well, first, the millionaire boom proves that long-term investing actually works. Compounding is real and it's powerful. Second, it highlights the importance of this participation. Even small, consistent contributions matter over time. Third, it underscores the urgency of starting early and increasing contributions as income grows. Waiting reduces the compounding window dramatically. And for the sake of it, let's just do one more simple example. If you invest $5,000 per year at 7% for 30 years, you end up with roughly $472,000. If you double that to $10,000 per year, you approach $944,000. That difference is not just the extra contributions, but the compounded growth on those contributions. Small annual increases in savings rates can produce massive long-term differences. That's the math working quietly in the background. And at the same time, we need to acknowledge the structural challenges. Not everyone has equal access to high wages, stable employment, or employer-sponsored plans. Broader policy discussions about retirement security remain very important. But at the individual level, maximizing what you can control still matters. Contribution rates, investment allocations, and timing the market are powerful levers. Even incremental improvements really do compound for you. Guys, the bottom line is, the 401k millionaire boom is real, but it only tells you part of the story. Yes, markets have rewarded disciplined investors. Yes, compounding has created a significant wealth for some, but median savings levels show that many adults are still unprepared for retirement. The gap between the top 10% and the median saver remains very wide. Understanding that reality should not create fear, but it should create urgency and focus is what really matters. Retirement readiness is less about chasing headlines and more about consistent action. Increase contributions whenever possible, capture the employer matches, and stay invested throughout all the volatility. Run simple math on your own numbers so that you know exactly where you stand. The boom shows what's possible, but preparation determines who actually gets there. Guys, I want to thank you for watching this video all the way through. If you feel you learned any value, I'd really appreciate it if you could smash that like button, leave a comment down below, and subscribe. I make new videos every single week, so stay tuned, and I'll see you in the next video.